Introduction to the stock market. There are two basic ways you can invest or trade in the stock market. The first way is called fundamental analysis. The biggest part of fundamental analysis involves delving into the financial statements. Also known as quantitative analysis, this involves looking at revenue, expenses, assets, liabilities, and all the other financial aspects of a company. Fundamental analysts look at this information to gain insight on a company's future performance. But there is more than just number crunching when it comes to analyzing a company. This is where qualitative analysis comes in, the breakdown of all the intangible, difficult to measure aspects of a company. Fundamental analysis serves to answer questions, such as, is the company's revenue growing? Is it actually making a profit? Is it in a strong enough position to beat out its competitors in the future? Is it able to repay its debts? Is management trying to cook the books? The various fundamental factors can be grouped into two categories, quantitative and qualitative. The financial meaning of these terms isn't all that different from the regular definitions. Here's how the MSN Encarta Dictionary defines the terms. Quantitative, capable of being measured or expressed in numerical terms. Qualitative, related to or based on the quality or character of something, often as opposed to its size or quantity. In our context, quantitative fundamentals are numeric, measurable characteristics about a business. It's easy to see how the biggest source of quantitative data is the financial statements. You can measure revenue, profit, assets, and more with great precision. Turning to qualitative fundamentals, these are the less tangible factors surrounding a business. Things such as the quality of a company's board members and key executives, its brand name recognition, patents, or proprietary technology. Neither qualitative nor quantitative analysis is inherently better than the other. Instead, many analysts consider qualitative factors in conjunction with the hard quantitative factors. Take the Coca-Cola Company, for example. When examining its stock, an analyst might look at the stock's annual dividend payout, earnings per share, pay-earnings ratio, and many other quantitative factors. However, no analysis of Coca-Cola would be complete without taking into account its brand recognition. Anybody can start a company that sells sugar and water, but few companies on Earth are recognized by billions of people. It's tough to put your finger on exactly what the Coke brand is worth, but you can be sure that it's an essential ingredient contributing to the company's ongoing success. The second technique, which is also popular, is technical analysis. This uses price charts as data to reveal more about the company and profit from the patterns that emerge from this data science. Financial securities are traded all over the world in places called exchanges, and the denominations by far cross hundreds of billions of dollars every single day. These trades take place on stock exchanges. When a trade happens on a stock exchange, it leaves a price data footprint. At what time the price was traded on, what was the transaction value, how many shares, and so on. What technical analysts do is gather all this information with other information like volume and derivatives of price, which we call indicators, and put it in a visual format called charts. This is an example of a candlestick chart, and this is what a bar chart looks like. Sometimes people just want an average idea of where the stock is going, so we look at line charts. This doesn't have a lot of data in it because it only plots the close for a day, but it still serves the purpose for the people looking for the general direction of a stock market. So technical analysts are basically data scientists. Larry Page, the owner of Google, who's also the richest data scientist, once said that curation and analyzing data and interrelationships is very important. Technical analysts believe past trading activity and price changes of a security are better indicators of the security's likely future price movements than the intrinsic value of the security. Technical analysis was formed out of basic concepts gleaned from Dow theory, a theory about trading market movements that came from the early writings of Charles Dow. Two basic assumptions of Dow theory that underlie all technical analysis are 1. Market price discounts every factor that may influence a security's price, and 2. Market price movements are not purely random, but move in identifiable patterns and trends that repeat over time. Technical analysis is used to attempt to forecast the price movement of virtually any tradable instrument that is generally subject to forces of supply and demand, including stocks, bonds, futures, and currency pairs. In fact, technical analysis can be viewed as simply the study of supply and demand forces as reflected in the market price movements of a security. It is most commonly applied to price changes, but some analysts may additionally track numbers other than just price, such as trading volume or open interest figures. Over the years, numerous technical indicators have been developed by analysts in attempts to accurately forecast future price movements. Some indicators are focused primarily on identifying the current market trend, including support and resistance areas, while others are focused on determining the strength of a trend and the likelihood of its continuation. Commonly used technical indicators include trend lines, moving average and momentum indicators such as the moving average convergence divergence (MACD) indicator. Whether you're an investor or a trader, use charts or financial ratios to make your decision. 3 things are vital to be profitable: the risk-reward ratio, a consistent risk management per trade, and high probability trades. All in all, buying and selling lukewarm setups will do you no good. They will increase your financial costs without delivering satisfactory returns.